Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today we're going to analyze Amphenol, ticker APH. This one came in by request down in the comment section of one of my other videos. If you have a request of a stock you would like me to analyze or give feedback on, drop it down in the comment section. I'll get it on this whiteboard behind me and eventually I will make a video. If it's a stock that's in the S&P 500 like this one is, I will post the video on YouTube for free. And if it's not, I post the rest on Patreon, which is $5 a month. And if you join there, you can get a big discount to my full service, which is hosted over on Seeking Alpha. And I will have those links down in the description. As always, this isn't individual investing advice. This is just how I analyze stocks. And I've followed Amphenol for a very long time. But I've never, I went and checked, at least I don't see that I've ever written on it before. Probably because it's always been kind of richly valued since I started writing about stocks, but it's never been like super crazy overvalued where I felt like I needed to warn people about valuation. If we look back to the last time they had any significant earnings drawdowns or earnings growth declines, it was during the Great Recession, about 21%. I would consider this like moderately cyclical. The stock price, however, looks like it dove quite a bit here. Yeah, over 60%. So a little more so than the wider market, I would say. But it recovered pretty quickly once earnings recovered. So very high quality business, definitely one I would be interested in owning the stock. It's really just a question of how much I'm willing to pay for that. If we shorten this time frame down to 2015, which is usually where I kind of start more recent analysis, for a relatively steady earning stock, we have a couple years where, and this was a COVID year, but even leading into it, they had kind of a weak earnings year. This year was 20%. 21% growth, but this was a tax cut year. So maybe assume this would probably have been a little bit less, maybe more in line with these past kind of low teens, we'll call it, earnings growth. And then these big years were COVID years. So you kind of have to asterisk them as well and kind of take all that into consideration, I think. And we saw that last year where earnings were flat, basically. But they didn't drop down off of this COVID bump, at least not yet. So this is kind of pretty much what you would expect from like the average high quality stock in terms of earnings. Let me see what my earnings growth assumption is here, like 12.5% earnings growth. I do take into account this basically not much of a drawdown there. I'm actually higher than FastGraph's estimates, probably because I pulled forward these earnings, which are expected to grow 9%. FastGraphs is probably using these. So yeah, I think this is pretty straightforward, honestly. Now the issue that we have is, so 12% earnings growth over this time is really good, especially with minimal cyclicality. I don't see anything unusual. I don't think they have very much debt at all, basically none. So all that looks really good, and the only problem is it trades at a 34 PE ratio. So when things are good like this and market participants think they can predict what earnings are going to do, and they aren't very cyclical, they don't really have a big dividend, but they do pay one, these stocks just traded a premium right now. So, and a big premium. So let's see what kind of returns we would expect from the stock if you paid for it today. So because it's straightforward, there aren't too many adjustments to make. Using those forward earnings, the PE ratio comes down from that 34 to more like 31. That's about a 3% earnings yield, which is the inverse of the PE ratio. So earnings over price. Very small adjustment for a tiny amount of debt that they have is in there. So the way I think about this is, if you bought the whole business for $100 and you kept all the earnings for yourself as the business owner, you would earn about $3 a share, about $3 on your $100 the first year, and that would grow at 12% or 12.4 or whatever I used each year. And keep in mind, the $103 isn't growing at 12%, just the $3.40. And then this is how much you would accumulate over time if you just took took those earnings, and these are not reinvested back into the business. These are assumed that you could take them and spend them and do whatever you want with them if you own this business. And what I want to know is how much I would collect over that time. So I start with my $100. I end with about 161. If you put that in a CAGR calculator for 10 years, you come out with about 5% CAGR. A little under that. 5% is the threshold that I use to consider maybe selling a stock. And you can see that this is basically right on the borderline. So that kind of makes, obviously it's not a buy. This would need to be about, if you don't take the recession into consideration, it needs to fall about 50% still to become a buy in my world, and maybe about half that far to be at like the midpoint of fair value. So probably more like 70 a share, 70, 75 would be fair value. This might be one a person might consider buying at fair value. What did I say? 70, 75. So you definitely could have got it back here around there, although earnings have grown a lot. But even here, that like 75 was doable if you wanted to just pay fair value for it. So, I mean, if you're patient, I think you could definitely probably get something like that. For me, obviously, I'm aiming for more of a margin of safety. And so I want to know what the PE would have been. So just roughly, yeah, like a 25 PE makes a little more sense. Maybe more like a 20. Back here, it was close to that. Not sure why I didn't buy this one back. That's probably why I remember it. It probably came close to becoming a buy, and then I didn't quite get there, and that's probably why I remember it so well, even though I didn't ever write on it. So yeah, that's pretty much it. I mean, in terms of whether to sell it or not, I mean, that just really depends. The market is a little cheaper than this, but it's probably also less high quality, I would say, on average. So, I mean, I don't know. It really would depend. It might be one where you just sell half and hold the other half for the long term in case the price never comes down far enough to buy it again. Especially if you're playing with the deep buy prices like I am. If you're not, and you're willing to buy it back at that 75-ish level, like maybe 25% lower, 30% lower, that I think will probably happen at some point in the next couple years. So if you kind of would want to take profits and sell, but some people, if it's in a taxable account or something, don't want to. It doesn't necessarily make sense to pay a 20% capital gains tax and then buy back 30% lower. I mean, it's okay, like the math works on it, but the taxes are guaranteed. The fact whether it will fall down to a viable price again is not guaranteed, so there's definitely still a trade-off there. So yeah, it might just be one that you just kind of hold or maybe trim a little bit. If you own it, definitely not cheap enough to buy here. I would just sit in treasuries or whatever and wait for a better price. Okay, if you found this useful, hit the subscribe button. If you have a stock you want me to take a look at, drop it in the comments section. And I will see everybody later.